everyone. A very good evening. You're watching The Money Show on ET Now. This is your daily dose of 1 hour of personal finances. I'm Mubina Kapasi, and let's tell you what we have lined up on today's episode of the show. First up, it's the first of the month, a brand new month, and I'm hoping that a lot of you guys have received your salaries or your monthly incomes that you do usually tend to get at the beginning of every month or at the end of the previous month. Be that as it may, it's important that you don't simply spend away that salary, although mind you, in this largely social distancing measures that we're all practicing, I'm hoping that, or rather there aren't much avenues where we can at this point of time spend our money, but nevertheless online shopping still can be a very, very enticing lure. So yeah, how exactly should you efficiently utilize this newly received monthly income or salary? That's what we will be talking about on today's episode of The Money Show. We'll also be talking about how salaries itself have changed. Have people got a hike this year? Are you the only one who's not got any hikes? And also, how can you judge if your company will be able to give you a hike in the next year? Basically, if all the efforts that you're putting in is simply coming to nowhere, where companies are not even being able to cover the inflation that takes place every year, should you essentially consider moving on perhaps to another job? Deloitte has a very interesting report on all of these pointers. We'll be getting on board, the partner of Deloitte, Mr. Ghosh. And finally on the show, we'll be discussing the sovereign gold bond scheme. The latest tranche is live for subscription. Should you subscribe for it? That's the question that we will get to answering. So we have with us Mrin Agarwal joining in on the show. Mrin, a pleasure having you with us. Thank you for joining us today on The Money Show. So to start with, like I mentioned, right, it's the first of the month and a lot of us have got that salary or any other form of income, could be rental income, that must have got credited to our bank account. And, how would you say efficiently one should utilize this money so that, you're not left with that end of month syndrome where, you've got barely any money left in your bank account or your wallet?
Well, as always, nice to be here today on The Money Show, Mubina. And as far as your salary is concerned, well, I think the first thing is to really set aside some amount of money for expenses, set aside some amount of money for savings. And of course, it doesn't have to be, to the last paise, but have a clear demarcation in terms of your spending amount and your saving amount. That's point number one. Secondly, of course, now being the 6th month of the lockdown, I think, all of us are in this thing that we really want to spend money somehow or the other. And if we cannot get out and spend it, then why not just spend it on e-com websites? So I think, we have to keep some of those urges aside. Of course, I have always advocated having a discretionary spending plan, because let's understand that while we have our essential expenses, we all need discretionary expenses for having fun. So always budget in an amount for discretionary expenses. I think one of the things that you should not be doing is certainly taking Insta loans, because nowadays loans are very, very easily available. And we have this tendency to just go out and take them for every small little thing. So I think, these are some of the things that you need to be doing. Essentially, what it means is that you need to be following a budget.
Okay, so yeah, creating that budget is extremely important. But how can, Mrin, where do you sort of start off if somebody, inspired, of course, listening to you, and if they want to ensure they stick to this budget from the first of every month, and when better than to start off now, right? So how do you essentially suggest they start off in creating a budget?
So we advocate the 30-30-40 rule, which is 30% expenses, 30% EMI, and 40% savings. I know it can be a little tough because 40% savings is not easy to do. But what I would suggest is that if, let's say, you're taking home 100 rupees, so out of every 100 rupees that you take home, you keep aside 60 rupees towards expenses and keep aside 40 towards savings. And, even if you can't get to the 40 number, if you're starting off with 25-30%, that itself is a good start. But obviously, you do need to start looking at working towards the 40% number. I think keeping a track of expenses, and there are a lot of expense apps out there that you can use, or You can just use a simple Excel. And again, as I said, you don't really need to get it down to the last decimal. I mean, as long as you have a fair idea that these are the amounts of money that I'm spending on essentials, these are the amount of money that I'm spending on non-essentials, I think you should be good to go. And it really just is this habit of having this financial decision discipline to say that I'm going to ensure that I save this X amount of money every month, irrespective of what happens. So if it means saying no to certain things, then so be it.
Identifying essential expenses, this is really the tricky part, right? Many times we get this question that, I have EMIs, etc. as well to pay. And, when you add EMI into expenses, it's finished, right? Because sometimes your EMI amounts too are extremely large. So does that as well come under the bracket of essential expenses? I mean, what all would you consider under essential? I'm sure food and shelter will be prime.
Food, shelter, transportation, your subscriptions, any other sort of rentals, for example, right? So all of these would be your essentials. And of course, you have the EMIs as well, which is sort of become part of essential expenses now, especially if it's EMI towards home. It is certainly part of your essential expenses.
Obligatory payments that includes EMIs towards home loans, car loans, or any other kind of obligatory expense is an essential expense. No two doubts about that. Okay. Now, you mentioned the 40-30-30 rule, right? So let's talk about that a little more. Investments, is around 30% of your expenses. So within the entire investment bit as well, what all do we cover over here? I mean, do we cover my SIP? Do we cover PPF? What investment? Do we cover fixed deposits as well?
Yes, absolutely. Anything that you're saving money for into, so it's your fixed deposits, it's your PPF, your mutual funds, NPS, anything that you're investing for your future is included in the investments part of the 30-30-40, or the 40% of the budget.
Okay, understood. Great. All right. So there you have it. That should be pretty simple, very simple 40-30-30 rule that you can essentially follow. And, that should sort of at least help you set out on the path of budgeting so that, you're not left floundering for cash, when you have to, when it comes down to essentially, properly spending the money. And yeah, that's essentially the simple rule. Okay, let's talk then more about investment, or rather, let's talk about the balance 30, which you mentioned. We say that's essentially used for emergency expenses as well. We spoke about 40, that's your expenses. We spoke about 30, that will be the investments. So the balance 30, Mrin, would be, how do you suggest that essentially is spent? I mean, as far as possible, do you think it's better off it's put in an emergency fund, or do you think it's okay if people, sort of use that for their other discretionary spends?
So I think, as I said, 30% towards expenses, which is your total expenses, which is your essential and non-essential. And I actually said 30% towards EMIs because I think EMI is like a really large component today. Now, with respect to your question in terms of discretionary expenses, it's really for the individual to figure out, what is going to be left after essential expenses, what is going to be left for discretionary expenses. But what happens is that when you do this sort of an exercise, you can actually get a fair idea of what your expenses are. The other bit is also from the 40% that I said for savings. Now there may be situations where you're not able to save that 40%, right? Because of various reasons. You might have maybe a high amount of loans. So actually, on the 40% also, you could also try to see if you have a lot of loans and you want to try to become debt free, then maybe it's a good idea to use some part of that to actually pay off some of your loans, especially if it's like these personal loans or these Insta loan, or if you've got like credit card loans, then maybe it's a good idea to kind of pay off these loans, because they're all at very high interest rates, and maybe your money is not going to be able to generate those sort of returns. On discretionary expenses, I really think that they should be capped at maybe 15% of the overall expenses.
15% of overall expenses, that essentially should be your discretionary expense. Don't sort of extend it beyond that. Okay, that 30 bracket, let's delve a little more in that, because even though it's just a 30% bracket and not the majority, many a times people need the most guidance on that, right, Mrin? So if somebody, let's say, has just received their salary, they've not been investing, but now they want to start investing, how do you recommend they go about their entire bit? Where should they start off, especially for those people who've not yet invested money in the market or in any asset for that matter?
So two things. First and foremost, build up the emergency cash, which is 3 to 6 months of your expenses. You can do it slowly. It's not like the immediate 30% you put everything into the emergency fund, but start building the emergency fund. The other thing is also to look at investing for other financial goals. So you might be wanting to buy a vehicle, or you might be wanting to buy a car, or you might be wanting to even save for retirement. So start investing some amounts of money for some of these financial goals. And I think automating expenses really helps, in kind of ensuring that the investments happen on a regular basis, rather than the money getting credited and then you going and making the investment every month. I think automating investments is a good way to ensure that those monies get invested and those amounts are really not lying in your savings account to get used up for expenses.
All right, okay. And within essentially the entire investment bracket, people, the traditional investment modes are fixed deposits and PPFs, and many times people think, okay, that's about it, because, I have my PPF, which also serves as a tax, as a tax instrument, and fixed deposits because, well, it's one of the most popular products in India, the safest as well, right, given the current environment. So how do you essentially get them to sort of change that mindset? And if fixed deposits and PPFs are already done, then how do you want them to essentially go about with the balance money?
I think if it's certainly people need to have some amount of equity exposure, and gone are the days where you can actually just plan for your financial goals with PPF and fixed deposits, given the fact that the returns are falling on both of these instruments. So certainly people need to take some amount of risk, and I would suggest that they should start off an SIP. If they're really unsure about which fund to go with, you can always go with an index fund. It's low cost, easy to track. You don't have to worry about what the active fund management part of it. Am I choosing the right fund, not choosing the right fund, right? So it's like a no-brainer fund that you can really start off your investment with. You can also start with a multi-cap fund, because again, that's a good diversified fund to start investing your money in. So certainly I would say take some amount of equity exposure. If you're only doing traditional investments, you need to bump up your portfolio by taking some amount of equity exposure, which is going to give you a better return over the longer term.
All right, well, there you have it. That's Mrin Agarwal talking about essentially how you can go about starting your investment, and essentially how you as well can go about with your investment journey. PPF and FD, as we know, is obviously not enough. You need to make some equity investments as well, because do remember we have inflation that's really eating into a lot of our returns. In fact, even if you look at fixed deposits, this is something that will not be able to cover the rising expenses, which is being reflected through inflation. By the way, Mrin, since I have you, I would like to take in your opinion on the news that we received yesterday, and that is with respect to the GDP. Now, when people see the number like this, and that's GDP, it definitely does scare them quite a bit, because, you say that, look, I'm investing in India's equity story, but then you have GDP which is declining 24%. That's almost a recessionary kind of view, right? So what's your view, your opinion to all these worried viewers?
Well, for those who have already invested, I would just say if nothing has changed with respect to your goal, remain invested, because also I know the number came much worse than what was expected, but at the end of the day, we all saw what we had gone through with the extreme lockdown, and it's not surprising that that this sort of a number came out. Yes, it's worrisome certainly, but I think in the long term, and again, if you do have a long term investment horizon and nothing has changed with respect to your financial goal, I think you should just stick through it right now and not get very perturbed by this number. Certainly, it is going to be a difficult time, probably for the next couple of quarters, given all the uncertainty that we're seeing around COVID. But I think the long term prospects of India still are very good. For those who are wanting to invest right now and who are confused and thinking, should I wait it out or what should I do? Well, you could always start investing. Again, very important, if you're doing equities, you do need to have a 10-year time frame. But you could start investing in tranches, is what I would recommend. And honestly, it's very difficult to time the markets. It's very difficult to know when the markets are going to fall and stuff like that. So I would just say that try to just break it maybe into 4 or 5 tranches your investment, to really do some bit of risk protection.
All right. So, but do you recommend they do any tactical changes, like, for example, perhaps increase, their cash exposure or anything like that?
Honestly, see, for people who are investing for their goals and they're really nowhere towards it, I don't recommend any changes like that. But yes, and Mobina, this is where I find that as far as individual investors are concerned, they actually find it very difficult to implement a core and tactical strategy, because what happens is that as a retail investor, I'm not really sure right now if the markets are going to go up further or if there's going to be like a big crash and stuff like that. So I always advise that as far as individual investors are concerned, I think they should just remain invested as per their goals. But certainly people who do have core and tactical allocation portfolios could look at maybe taking some money off at this point in time and remaining in cash. But those would be the more suave investors who are taking tactical allocations.
So essentially, for long-term investors, you don't really need to worry, because your goal is still far away, so you have time. So these all these crises essentially should not really worry you. And yes, we are sort of in the midst of a crisis, right, because of the COVID pandemic, and that's being reflected in the GDP number as well. Hopefully, of course, for the September quarter, the GDP number will pick up. There will be and fingers crossed, really, because the PMI number did show an uptick of 52. So that indicates that yes, slowly but steadily, manufacturing is picking up. But yeah, nevertheless, again, we know it's not just India, it's a blip that everybody is facing worldwide. So yeah, not too much of a worry. But again, it's something that you must keep note of. Okay, let's quickly take on board our questions and queries. First up, we have Saroj Kumar. He writes, I've invested money in Motilal Oswal Multicap over the last 2-3 years. Now he wants to know that the gain is not that great, especially when you compare it to other multi-cap funds. So should he redeem or wait for some more time?
Well, I think he should wait, because he's only invested for 2 to 3 years, and most funds actually go through these phases or cycles. As far as Motilal is concerned, I actually recommend that fund, because I find that they have like a good strategy in terms of stock selection, and they do more of like long-term investing. So certainly the portfolio is a little bit more concentrated as compared to maybe some of the other multi-cap portfolios. But I would say that please remain invested, and funds do go through cycles. And I do think that in the long term, the fund will pick up.
All Right, so there you have it. That's the word of advice coming in from Mrin for Saroj. Do take note of what she's essentially, saying when it comes to Motilal Oswal Multi-Cap Fund 35, Multi-Cap 35 Fund, and in fact for all our viewers. Okay, let's take on board our next query. Adi Sharma says, I'm 23 years old and my investment time period will be around 20 years. So clearly long-term investor, but here's the amazing part. He started his mutual fund investment around 2 years ago. The investment is done for the purpose of wealth creation to be used at the time of retirement. This is my current portfolio, all SIPs and direct growth options. So very confident young man. HDFC Balanced Advantage, Murray Asset Emerging Blue Chip, Axis Growth Opportunities. So it's roughly about around a 3,500 rupee SIP, largely a modest amount. Now he wants to start another SIP, and he wants to know if he should include a large cap fund or a debt fund for the long term. Okay, so he started off at 21. That's a great age to start off. We always say the earlier the better, because you have this wonderful thing called the power of compounding that kicks in. What's your view on this, on his portfolio, Mrin? He's got a very long term to go, and he may be young, so maybe his income as well may be a little lower. But he started off on the right note. What's your view on how he should go about?
Well, firstly, I find it commendable that, he started investing at the age of 21. So that's really nice to know. Secondly, he's looked at a balanced fund, and I think he's looked at some large and mid cap funds. Given his age and given the fact that he said that it's for his retirement, I certainly think that he should take some amount of mid cap or even small cap exposure in his portfolio and not stick to large cap. So this large cap bias may also be because of what we've seen in the last 2 years where large caps have done well. But given the long-term nature of holding, he should certainly include some mid cap and some small cap fund. As far as investing into a debt fund, I mean, that really depends upon what his risk profile is and if he wants to take debt exposure at this point in time. So that's the question he'll have to ask himself, that do I want to be entirely in equity or do I want to have some debt exposure as well? And there's no harm in having a debt exposure for retirement. I mean, there's nothing wrong with that. But the first thing he needs to ask himself is that does he want to have that? And if yes, then I would say that go with short-term debt funds, because I have found that the risk-adjusted returns in short-term debt funds are far better than dynamic bond funds or the longer duration funds that exist. So I would recommend either do the short-term debt fund, and if you don't want the debt exposure, then go with a mid-cap or a small-cap fund.
Okay, so perhaps a short-term debt fund would essentially work, and that's what the recommendation coming in from Mrin. All right, let's take on board another query. We have V. Rao writing, I've been investing varying amounts in mutual funds through SIP in 2011. Currently, he's investing $1.5 lakh per month. So it's quite a good amount that he's investing. And as on 31st March 2019, that's last year, his investment was 62.5 lakhs. It came to 80 lakh rupees, and then of course it fell to 63 lakhs, I'm assuming because of the entire lockdown in the market. So his questions are, the signs of recovery are a little bleak. According to him, that is, of course. He wants to know if he should redeem his funds, the ones that are currently lying, and should he again start a fresh SIP and reinvest the redeemed money when things start looking up later. Secondly, he wants to know about his investments. So he's got around 10 funds across, there's ICICI Pru Value Discovery, SBI Blue Chip, ABSL Equity, Motilal Oswal Focus 35, Tata Balance, Murray Asset Large Cap, Murray Emerging Equity, DSP Small Cap, Canara Robeco Emerging, UTI Mid Cap, and Franklin Focused Equity. So 10 funds. What's your opinion, Mrin? Too many, or do you think they're okay? Unfortunately, he's not written his time horizon, but he's been investing all the way since 2011. So what's your view?
Well, I can certainly understand that he's extremely worried about his investments, but honestly, it's very difficult to time the markets. And it's very difficult to say where the markets are going to go. So, and also, this strategy of exiting and then waiting and entering and all, we've seen it in the past that you can never catch the markets and you can never get the timing right. So certainly he'll just have to hold on. Secondly, in terms of the funds, I think there are too many funds. I mean, having 10 funds is like just too many. And again, like some of the funds, there would be an overlap. Like, for example, Mire Asset Large Cap and Mire Emerging Equities Fund, there would be a high amount of large cap, considering that one is a large cap and the other is a large and a mid cap fund. There would be a huge amount of overlap there. Again, focus funds have more concentrated risk. So I think he should really bring down his number of funds to 5 funds and stick with those. And probably, given his age, stick with the large cap and the multi cap exposure essentially, and then decide between small and mid cap which one he wants to have. But ideally, I would say that just stick with the large cap and the multi cap exposure in the portfolio and bring down the number of funds.
Bring down the number of funds. That's one advice, because 10 funds perhaps is a little too much. In fact, Mrin as well does say that, look, one fund already gives you exposure to, a good amount of stocks, and then you have 10 funds like that, so there is bound to be a lot of overlapping. So it's just over diversification, and it's really not necessary. Plus, it's a logistical nightmare as well to keep track of how each and every fund is doing, when you do your annual or semi-annual investment portfolio review. Okay, well, Mrin, on that note, we'll let you go. So thank you so much for joining us today on The Money Show. It's always a pleasure. But actually, Mrin, we are going to get you right back after this very short break that we will take, because we want to discuss sovereign gold bonds as well with you. So stay with us. And folks, before we take a break, remember there have been changes when it comes to the margin pledge system. This is something that will impact all of you who've been indulging in some, share trading, especially during this lockdown. And I know it's a whole host of you, because, there have been a surge in demat accounts open. Many people have been looking at this rebound in the markets, and they've been tempted really to put in a trade or two in the equity market. So here's how. Essentially, these margin pledge systems will affect your trading. My colleague Jayesh Khilnani joins us with an explainer.
What SEBI has done is they have created a new system in which it is called as the pledge and repledge system for the margin collection. Essentially, what it means is, despite the client giving a power of attorney to the broker, the client will still have to pledge on an individual basis. So, that POA will actually become a little redundant as far as the pledging and repledging of shares is concerned. Now, why is this done is because SEBI has implemented a rule saying that, even the cash segment trading or investing, that will require an upfront margin of as much as 20% when it comes to buying and selling of securities. So that is the reason, they are saying that one can also pledge their shares. Also, what this will actually do is a lot of BTST trades will be discouraged, as well as you will not be able to use the proceeds of any of the share sale that you have made today to buy another security till the actual amount is credited in the client account as well. So that's the hindrance that the market is working with. Also, the feedback that I have received from a lot of brokers is that a lot of small time brokers will get impacted because they have not been ready as far as the technical requirement is concerned for this particular system to be implemented. However, I do not see any feedback coming in of the same sort from the larger brokers that we have in the country. Some of the pros and cons that I have received from the market is, of course, starting off with the cons, is that this will actually put a lid on the broader market buzzing stocks that we saw. Of late, you saw in the last 1 month that there had been a lot of high beta names that had been gaining, so it will actually put a lid on those gains as well. Also, it is likely to reduce the trading volume activity, so that will be a dampener, and the STT would in turn get impacted. So, lesser revenue as well from the STT front. As far as the advantages are concerned, what the regulator is actually aiming to do is reduce the speculation that we have in the market, along with reduction in the misuse of the client securities that are done in the pool account.
All right, Jayesh, thanks so much for that explainer. On that note, we will take a very short break right here on the show. Don't go anywhere.